Hello and welcome to Trade Talks. Buying stocks isn't hard. What is challenging is choosing companies that consistently beat the stock market. There is something most people can do, which is why you're always on this hunt for stock tips. The strategies I'll mention are very easy to understand and yet difficult to implement. So guys, plan and execute. Warren Buffett once said, "Success in investing doesn't correlate with IQ. What you need is the temperament to control the urges that get other people into trouble in investing." Now, Buffett is referring to investors who let their heads, but not their guts, drive their investing decisions. In fact, trading over activity triggered by emotions is one of the most common ways investors hurt their own portfolio returns. So that's why you need to remember, buying a share of a company's stock makes you a part owner of that business. There might be an overwhelming amount of information when looking for potential business partners, but you want to know how this company operates, its place in the industry, its competitors, its long-term prospects, and whether it brings something new to your portfolio of business or not. It's really tempting to change relationship statuses with stocks, but making heat of the moment decisions can lead to the classic investing gaffe, which is buying high and selling low. Here's where the generalizing helps. Write down what makes every stock in your portfolio worthy of commitment, and while your head is clean, the circumstances that would justify a breakup. Spell out what you find attractive about the company and the opportunity you see for the future. What are your expectations? What metrics matter the most? And what milestones will you use to judge the company's progress? Catalog the potential pitfalls and mark which ones would be game changers and which would be signs of a temporary setback. On another note, sometimes there are really good reasons to split up. The company loses a major customer, the CEO's successor starts taking the business in a whole different direction, a major viable competitor emerges, or your investing thesis doesn't pan out after a reasonable period, many of these. But time, not the timing, is an investor's superpower. The most successful investors, they buy stocks which they expect rewards via share price appreciations, dividends, etc. and over years or for even decades. That means you can take your time in buying whatever you want to. Here are 3 buying strategies that can help reduce your exposure to the price volatility. The first one is dollar cost averaging. Now, it sounds really complicated, but it's not. Dollar cost averaging means investing a set amount of money at regular intervals, like once a week or once a month. What happens is that the said amount buys more shares when the stock price goes down and fewer shares when it rises. But overall, it evens out the average price you pay. Now, another effective strategy is to buy in thirds. What do? Divide the amount you want to invest by 3. And then, as the name implies, pick 3 separate points to buy shares. This can also be done in regular intervals. Let's say monthly or quarterly, or based on a performance of the company or based on company events. Like for example, you might buy shares before a product is released and put the next third of your money into play if it's a hit, or just divert the remaining money elsewhere if it's not. What if you can't even decide which of the companies will be the long-term winner? Well, we're going to buy them all. The third strategy is to buy the basket. And buying a basket of stocks takes the pressure of picking the one, which means this strategy will also help you identify which company is the one, so you can double down on your position if desired. Now, moving on to the next trading tip, avoid trading over activity. I know it's really hard not to obsessively check in your stocks, such as when you're receiving quarterly reports, but even that's too plenty. Trading over activity can lead to short-term events, focusing on share price instead of company's value, and feeling like you need to do something when actually no action is warranted. When one of your stocks experiences a sharp price movement, find out what triggered the event. Is this stock the victim of the collateral damage from the market responding to an unrelated event? Has something changed in the underlying business of the company? Is it something that meaningfully affects your long-term outlook? So guys, when you're picking a stock, you're picking a company, you're actually picking the business you have faith in. You're just not picking a market ticker. So please diversify your portfolio, follow these strategies, do a proper risk management. Thank you so much for watching this video. Comment below if you have been a victim of emotional roller coasters. To keep yourself updated on the latest happenings in the world of financial markets, subscribe to this channel. To learn more about trading strategies, register for our weekly seminars at www.century.ae. My name is Yogesh. You have a great week ahead.